Good evening, ladies and gentlemen. I'd like to welcome you to yet another investor update. I'm your host, Dan Theok, Senior Vice President of Investment Banking. Sharing the panel with me today is Justin Scott, Investment Advisor. Welcome, Justin.
Welcome, Dan.
Today we're discussing Nutwood Express Limited and Palace Amusement Company Limited, and we're excited to share these insights with you. If you like the content, don't forget to hit the like button and share this video. If this is your first time here, then be sure to subscribe and hit the bell to receive notifications. We upload content like this just about once a week. If you're looking to embark on your very first investment journey, take that first step with Mayberry Investments Limited. Follow us on social media today to get started. Okay, up first, we're going to take a look at Nutwood Express Limited. Let's get right into it. Okay, we'll be looking at the first quarter ended August 2023 for Nutwood Express Limited, and it was a great quarter. First up, we see revenues up by 18% to $492 million. And we see the gross profit relatively flat at $111.4 million because of a 26% growth in admin expenses. Finance costs were marginally up by 6%, and the net result was the profit before taxation was up by 2% to $98.6 million. So that was a great quarter at 17.2 cents compared to 16.8 cents EPS, up by 2% compared to the same time last year. Over the same period, we've seen total assets grow by a whopping 22% to $1.85 billion. And it's worth noting that they have $400 million in cash, over $524 million in investment properties, and a very good fleet of vehicles. Same time, they've managed their liabilities really tightly. They're only up by 3%. And shareholders' equity is up by 37% to $1.14 billion. What's impressive about Nutwood is the fact that they only have $300 million of debt, with $400 million of cash, so that net debt's zero. And with $1.1 billion of equity, you can appreciate that the debt-to-equity ratio is extremely low. In fact, like I said before, they have enough cash to clear the debt totally, but it's clear that they're holding some cash reserves to allow them to continue the expansion of the business. Speaking of expansion, we've heard of the fact that they're adding 2 more premium coach buses to the existing fleet of 3, and so it's good to see the potential for expansion continuing. They're already from Negril to Portland, 19 locations, and doing transfers between the 2 major airports, and this is a good stock that sort of supports the tourism sector, and it's good to see that. It's worth noting that since their IPO back in December 2013, this is essentially their last year of being on the junior market or receiving those tax benefits. So come January of next year, they'll be paying full taxes, and that's important to note as we go along. So interesting to see how we expect the business to continue growing along with tourism, but at the same time, I also expect that they're going to go to paying full taxes next year, and that should have a notable impact on the business. Looking at the key statistics, we see the stock price is at $12.55, which represents a PE of 20 times, which is a little rich in the junior market, where we see the average PE ratio at 6 times. Perhaps that's because the market's anticipating strong future growth in the stock. As I said, I have my little concerns because I'm expecting full taxation next year, so I think it's a little bit rich now. But all things considered, very strong balance sheet, little to no debt. So they've got the capital to expand, and they talked about adding 2 more premium coach buses. I want to remind you, this thing listed December 2013. They raised $100 million at the time. The company, 75% went to selling shareholders. That's to the Townsends and the Copelands, and 25% of those funds came into the company, and they listed back then at $5.11. So we've seen the stock price sort of grow almost triple over that period. They've certainly grown their revenues substantially, more than threefold over that period. So all in all, I think of it as pretty good success story in terms of a listing 10 years ago and how they've progressed and grown the business into a very strong balance sheet, very profitable, providing much needed services to 19 locations across the island. Not only are they doing the private coaches, the major public transports, the movements between the major airports and 19 locations, but they're also moving into the courier service, and they're doing a pretty good job. I personally used that service a week ago, and I was very impressed with the service. And so I definitely believe in their motto, moving things that matters. Coming back to the key statistics, so again, 20 times PE, so trading a little bit rich. Trading earnings of $306 million. And this quarter in particular is second best quarter we've ever seen. Going on to the next slide, we can look at those quarterly performances. So you can see at $86 million, that's the second best profitable quarter we've seen. 8 consecutive quarters of profit. So they're definitely completely out of the impacts of the pandemic and, doing pretty steady. So I expect profitability to be in that $80 to $90 million region until they start to pay full taxes, which could take away approximately 20% of that profit. I like the business. We see them expanding into investment property, as we mentioned, and they've done a great development out at Draxall, and that's generating about an 8 to 9% return. And so I expect to see the profitability from their investment properties improving as they fully build out the Nutwood Express Center out in Draxall. And so I definitely look forward to growth from the business, offset by the increase in taxation. But I think it's a rock-solid business that supports the tourism sector in Jamaica. A little bit richly priced, but, it doesn't hurt to add it to your portfolio if you like the business. It's certainly been rock-solid over the last decade, other than 8 quarters of challenges throughout the pandemic, but they're clearly back and doing very well. Last slide, if we look at the share price, we can see how the share price has traded up, pretty well in the last 12 months in the $12 space. Coming from a low of $8. So if you bought this thing at $8 for sure, you'd be in a happy place. You're up 50%. I think at $12.55, it's, fairly valued. We're certainly going to see the ability for them to pay stronger dividends going forward with $400 million in cash and little to no debt and a reasonably good fleet of vehicles, and then now them expanding into the investment property space. So I like it in general. I think it's a good one to have. If you have it in your portfolio, it's certainly a hold for me. If you don't and you like the tourism space and you're thinking long-term, I certainly think it's a good investment. Well-run business. Shares are tightly held with the Townsend and Copeland families owning 70% of that stock and holding on to that pretty tightly. So I definitely like this one. I think it's, fairly valued at where it's at. And I look forward to seeing the, growth potential in the future. Justin, what are your thoughts?
All right, Dan. So I definitely like where Nutwood is heading right now. So with the addition of the newly, the fully operational Nutwood Express Business Center, I think they've really set up a nice setup for themselves right now. As it is right now, they're pretty much cemented around $400 million top line as a basis of operations right now, considering the increase in tourism, the increase in the courier business, as well as the increase, as you would have pointed out, from the business center itself, which I think they might start to spec into a little bit further as they, interest rates come down and it's a bit more intuitive for them to go into acquiring more properties, building more into that region. As you know, they don't really like debt as much. They tend to keep it at a low level. So I'm expecting once things start to cool off a little bit more, then they might look into setting that up in maybe a Montego Bay location, especially if they actually do set up the new airport, which is in talks right now. But as it is right now, Draxall is a great starting point for them. I do like how they're headed. They seem to have leveled up just a little bit in terms of top line, but I'm expecting with continued tourism numbers to continue as they've been for like the last 2 years, then we can definitely expect Nutwood to continue along that same pace.
Yeah, thanks for that. I appreciate that. And for sure, as we see the tolls going up more and more, I think more and more people are going to get into the idea of using the service. And we certainly see flying out of Montego Bay to be a good option for folks who are traveling. And so using this service to get to Montego Bay and back to Kingston or the other many locations is absolutely a good option that folks should consider. So I think it's a good business, great prospects for the future. I like it. And so if you guys do too, feel free to get yourself some of it. Okay, up next, Justin's going to tell us about Palace Amusement Company Limited.
All right, ladies and gentlemen, next up is Palace Amusement. So Palace Amusement Company Limited is a cinema operator, leading exhibitor and distributor of motion pictures. They operate out of 4 movie theaters. Caribbean Cineplex is in Kingston, Multiplex in Montego Bay, and the Sunshine Theatre in Portmore. So taking a look at their financial highlights, Palace Amusement actually had their best financial performance out of the last 5 years. So if you take a look at the revenues, they did $1.5 billion in revenues, 134% increase to the same period last year. A 73% increase in direct expenses up to 1.2 billion. Naturally, based on their business model, the more people that come, the more direct expenditure that goes into their offerings and their operations. Gross profit is up to 297 million right now, which is about 19%. Our gross profit margin, significantly better than the 57 million gross profit loss in the previous financial year. Admin expenses increased about 19% to $208 million. And considering that they doubled sales the years prior when compared to 2020 or even 2021, admin expenses were roughly around 174 million and 130 million respectively. And it kind of underscores that there's a base level of their operations fixed into their cost structure, which can be good or bad depending on their operating levels that, based on the amount of traffic that they're experiencing. Operating profits of 105 million and finance costs of only $57 million of that, which actually brings them down to a $48 million profit before taxation, which is where I'll take a pause at the moment. So now this actually is really great for them, considering where they're coming from the pandemic. But right afterwards, they get into a $180 million tax credit, which actually significantly boosted their net profits, which is a point that I really want to highlight, particularly for this financial year. So the net profits that you're seeing right now, about 228 million, are really bolstered by that tax credit. That's not to discount the $48 million profit before taxation, considering that it's significantly better. It's probably about the best financial profit before tax that they've had since perhaps about 2018, 2017 thereabouts. So it's been a great quarter for them that really pushed them up into this level. But I just really want to highlight that same tax line right there. So that actually pushed them to earnings per share of 26 cents per share and a trailing earnings of about $228 million. So now this actually completely erased the losses that they would have had, the trailing losses they would have had from the year prior. So just to highlight, the profit of $228 million, while it's significantly, it's amazing, it's a great year for them, it's really bolstered by that tax credit that they had. But profit before tax, solid. $48 million, totally solid. So now let's take a look at the balance sheet. They have total assets of about $1.7 billion, a 1% increase from the prior year, and total liabilities of $1.1 billion. It's not a very heavy debt-laden company, but they do have a lot of liabilities that would have been making up for it. Total shareholders' equity of about $580 million, increased by that same net profit line beforehand. And when we get down into key statistics now, you see that current price is about $1.50 per share, and the P ratio of 5.6 times would have really been boosted by the net profit they experienced in Q4, and really, drew down on the PE ratio. A book value per share of 67 cents, and trailing earnings per share of 26 cents, and trailing earnings, as I said earlier, of $228 million. The 52-week high of 7.87. So now Palace Amusements actually kicked off the year with a 600-to-1 stock split in around February, which would have dropped the share price down from trading in the hundreds to trading into about 7.8, and it's down about 76% since the stock split down to a price of $1.50 per share. So moving on to the third slide, we can take notice of how the price has moved since about 2020 thereabouts, where the effects of the pandemic would have really whittled down the price. Now the price you're seeing right here is actually adjusted for the stock split. So when you see that it start in 2020, when there was really no operations or no significant operations, the price was roughly there about an equivalent of $2 per share. It had a real spike up in the ending part of 2022 into early 2023, when expectations of the stock splits had, really increased the amount of volatility. A lot of people are speculating about, what actions were to take place after the stock split. And so it ran up to an equivalent price of about $7.74 per share before, eventually, it split. And then the price started to trend down afterwards. Even the great deluge of supply, the amount of shares, people that were buying up, a lot of retail shareholders were participating in the stock split and really increased the amount of supply in the average person's hand. And so afterwards, when, when things started to settle off a bit, people realized they were kind of stuck with the stock, and it started to sell down a bit more, really pushing down the price to the current price we're seeing now of $1.50 per share, which is roughly around the baseline, where it's been trading for like the last couple of days, last couple of weeks. And even considering back to 2020 levels, where the baseline would have been an equivalent of about $1 per share. So if for those of you who are really interested in the speculations of it, it might be there, it might be an opportunity, especially considering that the previous quarter was so spectacular. And I'm expecting the following quarter after this one, given some of the really major blockbuster hits that took place, like Oppenheimer, the Barbie movie, Mission Impossible, Spider-Man, would really going to, directly increase their net profits. But so that might have, some interest for some people buying into it. And especially if some people are even just trading straight off a price action movement, that $1.50 might be, an opportunity for some people. But given the long-term aspects of it, I wouldn't necessarily say that this is a proper long-term buy and hold sort of investment for me. It's more about the volatility where I would find the value into it. Even going back to slide 2, you'll see the quarterly profit movements, and that's from Q3 2020 right up to about the fourth quarter of 2022. It was a straight net losses, and then it's been a bit sporadic since then. As I said before, Q4 was great for them, profit before tax, and then the tax credit, of which they have another $740 million in deferred tax assets, which they can use to benefit their tax line. But I wouldn't say this is going to be a consistent company that's really just hitting these numbers out of the park every single time. So I just wanted to point out that there's still some hope in a lot of people's minds, considering that there might be a significant capital raise that's on the line, especially following some great numbers that they will put out, which is one of the reasons I think they might have really chosen to put so much of their tax assets towards, of the tax credits towards one significant quarter, knowing that they're going to have another quarter or two of decent earnings, that they might use that time to strategically announce some sort of corporate issue, similar to how Cinema One in Trinidad would have announced a rights issue about earlier this year, raising about $130 million JMD equivalent, to purchase another cinema out in a plaza, in a high traffic plaza. They might be using this as a significant opportunity to raise a corporate issue, get a lot of people's interest in minds, considering how active the stock would have been since last year, to really capitalize on that opportunity. But as I said before, I don't know if it's going to be such a consistent company, especially the way how it is right now, and the way how the general market is going towards cinemas. But yeah, so those are my views. Dan, any words on this?
Thanks for that, Justin. Well, I definitely got excited when I saw the PE of 5 times, but then I did my deep dive and saw the $180 million tax adjustment. So I kind of think of that as one-off. And when you make that adjustment, then the PE falls from 26 cents to 5 cents, and then the PE skyrockets to 25 times. So I'd like to watch this for another quarter or two. I don't think they will possibly do better than $50 million in the next quarter, which was sort of what they did for the profit before tax. And on that basis, it's feeling expensive at 25 times. Also depends on whether you think this industry is really going to bounce back strong. And again, looking at their quarterly performance, you can see on that slide, they got hammered throughout COVID. And even a year after COVID, it was very sort of volatile results, making a profit one quarter followed by a loss, followed by a profit. And now this extraordinary profit, which has this unusual gain in it. So I'm going to stay on the sidelines with this one. I think I'd like to see another quarter or two to be convinced that this industry is really going to come back, because there's a lot of competition out there in terms of substitutes. And so I really wonder if the younger generation, which I'm no longer a part of, want to go out and have that experience. Justin, I can't say. But I personally would be on the sideline until I see the results for 2 more quarters. Well, thanks for that, guys. I appreciate it. I'd like to thank our viewers again for being a part of today's investor update. I'd also like to thank my fellow panelist, Justin, for his invaluable contributions and insights. We encourage viewers to follow us on social media for all things forum related. And don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. Thank you to all our viewers for tuning in today. Keep safe, and remember, wise investors, slow and steady wins the race. Goodbye.